Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking about inflation. It's been a while since we've checked in on the exact inflation data. It's continued to come down over the last year, but jumped up just a tick back in July. So I wanted to use today's episode to check in on the inflation numbers, what we're seeing in our office, what we're paying attention to, and what might be coming down the pipe. Jerome Powell and many other central bankers met recently in Jackson, Wyoming at Jackson Hole. They had a couple of press conferences. They made some interesting comments. We talk about it all in today's episode. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. This week on the show, I'd like to check in on inflation. Inflation is something that we've all been feeling here, certainly been feeling for the last couple of years, but the recent numbers over the last 15 months or so have been consistently positive. And this is a very interesting thing. And rewinding back here a few years, inflation just was incredibly low after the financial crisis and our recovery from that financial crisis back in 2008, 2009. Then fast forward here in 2020, we have COVID, everything shuts down, and we have all sorts of really unprecedented fiscal and monetary stimulus to help people throughout that time. I think the total tally of government support was maybe $6 trillion at that point that they pumped into the economy through unemployment extensions and the Paycheck Protection Program and all these other sorts of government programs to help stimulate the economy while everything was shut down. And then, not surprisingly, that led to a lot of inflation. It took a little bit longer for the money being dumped on the system to work its way through the system and result in higher prices. But now things are looking up. And I'm looking at my numbers here. I have some notes on my other screen. Inflation year over year change in CPI, the Consumer Price Index, it peaked at 9.1% in June of 2022. And since then, that annual number has gone down every single month until last month, until July. I'm sitting here recording this. It's Friday, September 1st, and we don't have August's numbers out yet, so it'll be interesting to see what happens in August. But between June of 22 and June of 23, it went down every single month. It went all the way down to 3% annual change year over year in June of 23. July, it crept back up just a touch, up to 3.2%. So I'd like to spend today's episode talking about where we're at, what we see coming down the pipe, what our decision makers are really thinking. Jerome Powell is the chairman of the Federal Reserve and continues to try to thread the needle between taming inflation and driving the economy into a recession. And that's the balancing act. That's the tightrope walk that all central bankers really need to undergo as their tenure as Fed chief. So a couple basics just to start us out. How do we measure inflation? Right? You and I go to the grocery store. We buy some chicken. We buy some cereal and some milk. I think everybody has probably anecdotally experienced the cost of those items going up. You go to the same grocery store every single week, the cost of buying the same stuff has just gone up. And so the way that the government measures this is that they have some government-sponsored agency, and I always forget exactly what the agency is, but they go around the country and they buy or I don't know if they buy or not, but they check the prices on a consistent basket of goods and services. And that basket of goods and services are stuff that consumers like you and me typically buy and typically put in our grocery carts. It includes other things not at the grocery store, like clothing and rent and all sorts of things. Now, the core CPI, there are a couple different measures of consumer price indexes. There are several different indexes, I should say. So one of them includes everything. The other excludes housing and energy, and there are others that cherry pick certain certain types of goods and services. We usually look at everything, the entire basket, when we're trying to evaluate this stuff. But as you know, oil prices kind of spike up and down. It depends on the demand for oil. It depends on what OPEC is doing, how much oil they're producing. And the price of energy tends to be a little bit more volatile than the price of like eggs and meat and milk and that kind of stuff that we buy at the store. So what they do, what the government does, is they go out and check the prices of all this stuff every single month. And then they come back with that data. They do it all around the country because the prices of groceries here in California, where I live, is probably going to be a little bit different than the price of the same groceries in New York or Alabama or North Dakota or Chicago or wherever, right? So they regionally check the prices, they compile it all into an index, and they track how much that stuff costs over time. So these numbers that we're looking at, I mentioned that in June of 22, the CPI was up 9.1% year over year. That means that between May and June of 22, the price of that same basket of goods went up a little bit. But between June of 22 and June of 21, the price of that basket of goods went up 9.1%. So these are all annualized numbers that we're looking at is what I'm trying to articulate. So inflation spiked, right? We were all seeing it. The price of pretty much everything, housing is still quite strong, and cars, if you need to buy a car, the prices are still very, very high. Inventory is kind of low in car dealerships lots. Then the Federal Reserve increased interest rates aggressively. And so what that means is Jerome Powell sits atop the Federal Reserve. The Federal Reserve is a system. It's our monetary bank. They control a lot of stuff. And there are 14 members from regional banks around the country that feed up to Jerome Powell's seat as chair of the committee. And so those 14 members meet throughout the year, and they vote and decide on what to do about short-term interest rates. Because since the Federal Reserve is engaging so much in the short-term lending market, they can dictate through their open market operations, and the FOMC stands for Federal Open Market Committee. They can set interest rates where they want by through those daily operations. So if they think that inflation is high, which it was in June of 22, typically what they'll do is increase interest rates. That's one of the arrows that the Federal Reserve has in their quiver to employ monetary policy and balance that equation between inflation and economic growth. So they meet throughout the year. They set interest rates. Inflation looks like it's going up, and so they started increasing the federal funds rate. That's the overnight rate on cash. If you want to borrow money from the government through the federal window, if you're a bank and need to access that, that's the rate that you pay, the federal funds rate. So if they increase interest rates, it typically slows down the economy and puts the brakes on inflation simultaneously. Because money is more expensive to borrow, the reason that we have inflation in the first place is, think back to your economics 101 supply and demand curve. There's more demand for goods and services than there are goods and services available. So if you and your 5 friends all have a flat tire on your car at the same time, and you'd like to put the spare tire on, drive it over to your local mechanic and have them fix the tire, but there's only one mechanic available to do it, he has a lot of business, and he might start charging a little bit more for that same service because there's more interest in having the tire changed than there are mechanics available to do it. So because anytime there's a lot more money floating around through the system, there is more cash available for people and businesses and organizations to buy and bid up the price of goods and services. There's a lot of cash in the system, more cash than there are goods and services available. And that's what happened after we printed all this extra money and injected it into the financial system. So it drove up prices. The Federal Reserve, the first thing that they typically look at is raising short-term interest rates to reduce the demand for goods and services, which slows the economy down. They want to put the brake, and when I say put the brakes, that's exactly what's happening, is when money is more expensive, there's simply less of it floating around through the system. It gets more money into the banking system because depositors like you and me can now earn a little bit more on our savings. We've talked a lot on the show about what to do with your extra cash. If you can get 4 or 5% on your savings account now, I'm more likely to keep it in the bank than I am to go out and go spend it on a new iPad or whatever else, right? So they started raising interest rates. They did so consistently throughout last year and into this year. And while it took a little while for that to take hold, so I should have looked that data up before today's episode, but I didn't. They started raising interest rates. It takes a little while for that action to have a direct impact on inflation. So they start raising interest rates. It's not like every single month, no matter what. This is not a mathematical certainty kind of thing. This is more a society, socioeconomic thing, where when interest rates go up, that typically has it puts downward pressure on inflation, but sometimes it takes a little while for that to take effect. So they started hiking. Interest rates did start going down, as I mentioned, in June of 20, or after June of 22. June of 22 is when they peaked, and now they're back down to 3% in June of 23, and then they bounced just a little bit to 3.2% in July. Now, central bankers like to have a little bit of inflation. Having a little bit of inflation is good for the economy, and their target is 2% on an annual basis. I say it's good for the economy mostly because what they really, really want to guard against is deflation. And deflation, you might think, well, what if wouldn't deflation be good if the price of my eggs at the grocery store is going up 10% every single year? That's clearly bad for me as a consumer and bad for the economy. But wouldn't deflation be good if the price of my eggs went down instead of up? And the answer is, it might be good for you as a consumer, but it's really, really bad for the businesses and supply chain and the economy getting the eggs from the chicken to you. And what it results in is if prices are falling, revenues for the businesses in that supply chain go down quickly, and they have to start cutting costs and laying people off. And from an economic standpoint, it's really, really bad for the country as a whole. So the main reason that central bankers like to have a little bit of inflation is just to give them some wiggle room on that downside, because deflation is really, really bad. So now we're closer to the target, right? 3.2% year over year. The Fed still has this needle to thread. And what's interesting about this is that pretty much everybody has been wrong over the last couple of years. If you were following the news in 2021, 2022, the commentary was that the Federal Reserve is really dumb. They're making horrible decisions. There is no possible way that they'll be able to navigate the this balancing act between taming inflation without driving us into a huge recession. And that's, I spoke a moment ago about the impact of raising interest rates. That's what happens. Rates go up, money gets more expensive. It really does put the brakes on inflation, but also on economic growth. And the tightrope that they're trying to walk, they have two objectives. The Federal Reserve exists because they want to keep the prices under control and the value of the U.S. dollar under control. And secondarily, that's the first objective is price stability and inflation. The second objective is economic growth and full employment. Those are the only two things, right? I don't know this for sure, but I'm pretty sure that in somewhere in the legal system, the Federal Reserve exists with those two objectives that's written into law. So they're always trying to balance this. And there was so much animosity expelled toward the Federal Reserve and Jerome Powell because everybody thought that he was acting too slow. He was allowing inflation to creep up too quickly. And there was no possible way that he would be able to get inflation under control. So by acting too slow, he was allowing inflation to rise too quickly. And by not acting more swiftly, it would spin out of control, and there would be no way to get it under control, reduce inflation without driving us into this huge, big, bad recession. And if any part of that was true, it's that he and the rest of the Federal Open Markets Committee, the rest of the Fed governors, may have been a little bit slow to raise interest rates. There was the $6 trillion of stimulus clearly led to inflation. You know, I think the popular opinion on that was right. A lot of people were clamoring for that. We didn't know one way or another, but there were a lot of market commentators, I think, that got that one right. But they really have done an admirable job of getting on top of it since then without driving a stake into the heart of the economy. And so I've got some numbers and subtext there that I want to go through that I was curious about before recording this episode. And when I say the economy is really pretty resilient and strong, these are the numbers that I'm looking at. Number one, the jobs market is still strong. There was the numbers from August did come out today in terms of payroll and wages and so forth. And the unemployment rate ticked up just a little bit from 3.5 to 3.8% month over month between July and August. But wages went up 4.3%, which is good. And the bulk of that increase in the unemployment rate was because of two reasons. Number one, there's a big trucking company that went out of business, Yellow. You may have read about that in the news. It has a huge reach. There are a lot of truck drivers that were simply laid off. And there's a big writer strike going on still in Hollywood. All the Actors and Writers Guild people are on strike still. That's primarily what led to that jump. So the jobs market is pretty strong. Wages are growing. Employment is good. Economic growth, GDP growth is still pretty strong. The areas where I see potential weakness here coming down the pipe are that the Fed raised rates very quickly to get inflation under control. And there are ramifications across the economy related to that we just haven't seen yet. And I'll go through a few of them. A few that we have seen, though, is with the regional banking industry. Remember the Silicon Valley Bank ordeal from earlier in the year when they went under? And there was First Republic Bank as well. Those institutions were crushed by higher rates. They were acting stupidly, in my opinion. They made some really, really bad risk management decisions. But they would not have been in that sticky situation if the Fed had raised interest rates earlier over a longer period of time. They would have had more opportunity to trade their way out of the debacles that they found themselves in. So that's one impact of higher interest rates. Here are the others. You raise rates, now all of a sudden your mortgages are more expensive. And to be clear, the Fed doesn't have any direct control over the mortgage rates that you and I might pay if we buy a house. They only control the overnight, very short-term rates. But the mortgage rates are somewhat adjacent to them and are influenced by what happens on the short end of the curve with the federal funds rate. So mortgage rates are higher, which means that people are reluctant to sell their homes and move. Because if you buy a house if you have a house for $600,000, you have some equity in it, and you want to sell it and, I don't know, downsize and move closer to your kids, it becomes way more expensive to sell your $600,000 house, take the cash, and then go buy another $600,000 house. Because you might have a mortgage at 3%, the new mortgage might be around 7%. Your monthly payment is a lot higher. So people have just been reluctant to move because they have such good deals, relatively good deals on their pre-existing mortgages. This can go on for a while, but it can't go on forever. People do have to move from time to time. And while we can wait it out a little bit, there will come a time when people simply can't wait anymore. And by moving, they are incurring greater housing costs because they have to get a mortgage at a new rate, and they have less money left over to go put into the economy and buy other stuff. Auto loans are another situation. Auto sales haven't slowed down quite a bit, very much yet, I should say. Inventories at auto dealerships are still very low, but a lot of people, I think, are reluctant to trade in the cars that they do have because interest rates are higher on the new models, and the new models themselves are a heck of a lot more expensive. So prices haven't have really set themselves at those higher levels over the last couple of years. Now, what's interesting with the autos is I have seen in a couple places that repossessions are way up. That hasn't trickled down to more inventory being available on your local car dealership lot, but the cars that people are buying are being repossessed more frequently because guess what? People are paying a lot more. Their monthly payments are way up. I read a stat the other day that over the last 3 or 4 years, the average monthly car payment is up over $150 a month. So think about what that does to the economy. You have $150 a month of less cash available to go do other stuff with. So this is something that is might be starting to crack a little bit. Interest on credit cards. A lot of people have balances on credit cards. If you're someone who has a balance on a credit card and you keep a balance and pay interest on it, I am urging you to do nothing else in your own financial plan than try to squirrel away a little bit of cash every single month and work that balance down. There is nothing better that you can do because the rate on interest on credit cards is just really high. So when interest rates go up, the rate on your credit cards, which are already high, go up a little bit more. And the interesting thing there is that interest coverage as a percentage of personal income, so if you make $100,000 a year, 2 years ago, the average American used 1.2% of their income to service debt. Not mortgages, I'm excluding mortgage debt, just credit card and auto loans. 2 years later, that's gone up by 1% to 2.2%. That's largely because interest rates have gone up, right? So on the consumer side, people are staying in their houses longer because they don't want to move and incur greater costs. They are having cars repossessed more frequently. Sales haven't slowed yet, but I think that they probably will in the next couple of years. And substantially more personal income is going towards servicing the debt that already exists. So none of these things can go on forever, right? This will come to a head at some point. Now let's talk about what this means for businesses and other kinds of real estate. Well, corporations, the businesses like to borrow money from their bank or from the bond markets to finance their operations. And a lot of that debt is maybe 2 years, maybe 5 years, maybe 10 years, something like that. So the smart CFOs of publicly traded companies took advantage of lower interest rates between 2010 and 2020. And then when rates started to go up in 2021, now any organization that has to refinance their debt or roll that debt over into a new loan is paying substantially more because interest rates have gone up so much, right? So because rates have gone up relatively quickly, this hasn't come to a head for most corporations. They haven't had to refinance their debt because this is still only maybe 18 months old, is maybe 18 months from the time that they started raising interest rates. That's not permanent either. If you have a corporation that does nothing to finance their operations other than issue 5-year bonds, and every 5-year increment they renew, then at some point in the next few years, they're going to have a whole bunch of bonds that they have to renew, they have to roll over, and that will be at higher prevailing interest rates. So that's a challenge for corporations, right? If your expenses on the debt that you're servicing go up substantially, then you have a lot less money to do other stuff, just like consumers. And when your credit card and auto payments go up by so much, you have less money left over for other things. Now you have corporate real estate too, right? Corporate real estate is something everybody's really freaked out about. You may have heard the news. There was it was a big office building, a high rise in San Francisco on Market Street. And I think the building was purchased maybe 5 years ago for about $300 million. It's about to hit the market for $60 million. And the way that these commercial real estate loans work is usually they amortize over 20 or 25 years, but the rate resets every 5-year increment. So again, 5-year term. If you're someone that got a huge loan to go buy a big old office building 3 years ago, then you are approaching the date at which that interest rate is going to reset. And on a large commercial real estate loan, if your previous rate was 3 and now you're going to have to pay 6, that's a substantially more for your monthly interest coverage just to keep that building. And if the rents coming in from the building aren't enough to make the payment, guess what? The bank is going to come after it and potentially foreclose if you can't make the payments after a long enough period. So what do you have to do? You have to raise the rents on people, and that hurts the businesses or other occupants of the building. So none of this stuff has really come to a head yet. And then the other item is, I keep using this 5-year increment. For our federal government, we have we run big deficits every single year. We spend more money than we take in from tax receipts. And as I've tried to argue and articulate in the past on the show, we can do that. That's okay. That's not a bad thing. You and I as individuals can't do that because we'll wind up in a huge amount of debt. It'll be a huge mess. But governments can. It's a totally different thing. So we run deficits every single year. We have to borrow money to finance the difference between what we're spending as a government and what we're taking in from tax receipts. 67% of our federal debt is going to need to be refinanced inside of 5 years. So that's a little bit scary because the same is going to be true for our federal government. We'll have these outstanding treasury bonds that mature. The government's going to have to pay back bondholders. You probably have some government bonds in your retirement accounts that, whether they're in a bond fund or an explicit U.S. government bond, the government's going to need to pay you back. And they're probably going to want to just roll that over and issue new bonds to replace them, because otherwise the government's going to have to come up with a whole bunch of cash all at once, which is not good. So they'll have to borrow at the higher rates too. And that's a little bit scary because we run substantial deficits, at least we are right now. We just printed a whole bunch of money, $6 trillion. And our choices for how to wriggle ourselves out of that become narrower the larger our debt load becomes. I'm not super concerned about this tanking, the United States empire or jeopardizing the dollar's status as the reserve currency. I don't mean to be too negative about this one point, because they do have a lot of options and a lot of ways to manage that. My point is that rates have gone up dramatically in the last few years. They've been successful in getting inflation down. It's not quite down as far as we want, but it's getting close. And the needle will be threaded that the Federal Reserve is trying to balance. They will accomplish this if they can get inflation down before these cliffs that are coming up for businesses, for individuals, for our own government, and for corporate real estate. If inflation is stubborn and the Federal Reserve doesn't have a chance to reduce interest rates at all, or if the economy really does slow down rapidly and they reduce interest rates, if rates remain high when we start approaching these cliffs over the next couple of years, that's going to be a problem for the economy and will likely drive us into some kind of recession. So people have been hating on the Fed for the last couple of years. They've really done a pretty good job so far. Yes, inflation is higher than we want. It was way higher than we wanted about a year ago. But all things considered, they were able to increase rates without tanking the economy yet, get inflation under control, and the stock market has been really, really good year to date. And those three things very rarely happen simultaneously. And I think is definitely a credit to Jerome Powell and the other members of the FOMC, and just a pat on the back of their reputation. Now, that's where we're at now, right? This could all change next week if the cracks really start showing. But for all intents and purposes, it's pretty positive at the moment. So what I'm really looking for is every single month, the government agency that tracks prices communicates what that month's inflation print is, or what that inflation number is. We say print, numbers are printed. And if it goes up from July, from 3.2% to something higher, it's a little bit more concerning to me. If it bounces back down to 3%, it means that our trajectory is good. It gives the Fed more latitudes to hold rates steady without increasing. The futures markets, futures are a contract on a certain interest rate or a certain asset in the future. And they will tell us what the market thinks is going to happen to interest rates and the Federal Open Markets Committee. And so it's interesting to check in on what the futures market says about specific asset classes, just to see what the markets really think. And right now, based on the futures market, participants think that there's about a 50-50 chance that Powell and the rest of the FOMC have to raise interest rates again between now and the end of the year. Just recently, they had this big convention in Jackson, Wyoming, at Jackson Hole. They do this every year. A bunch of central bankers come and they share notes and issue press releases and have press conferences and all this. And so the markets were really waiting to hear from Jerome Powell after having met with other colleagues, and he had been scheduled to make comments for a long time. And his words were that we will proceed, I think his words were, we will proceed carefully with any future interest rate increases. The economy has not cooled as quickly as we expected, but inflation continues continues to. And I'm probably bastardizing his exact words, so don't take me on that word for word. But basically, he's saying that the economy didn't slow down as much as they had expected after the dramatic increase in interest rates, and they will proceed carefully with future increases. So that's where we're at. We have a little bit of window here before the higher rates will really have a more dramatic impact than they have already. Again, we've started to see some of the impact with these regional banks. Coincidentally, Moody's and S&P downgraded maybe half a dozen or a dozen regional banks their credit ratings over the last couple of weeks, and so that has continued to be an issue for smaller regional banks. But there are a whole bunch of other sectors of the economy that will be impacted by this over the next couple of years. So that's where we're at now. Fingers crossed that the inflation numbers continue to fall. If they fall below 2%, then maybe we start seeing more interest in a faster reduction in rates. So that's it for today. Hope this was helpful. These macroeconomic things are super interesting to me because it's not this isn't like chemistry where you get 2 hydrogens and 1 oxygen and you get water every single time. This is more of a social science, right? And we have all these different pressures and all these different mechanisms for how that go into how the economy is put together and how it works. And every situation is different. You could have the exact same inputs and get totally different outputs in two different circumstances, which is why it's very interesting to me. So that's where we're at. Those are the things that we're looking at here, and I hope you found it interesting. That's it for today, and I'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.